Hello and welcome back to our channel. In our last video, we spent a bit of time looking at bonds. As we saw, the bond market is very important to us all for three main reasons. First, it's where governments get a great deal of their money from. Secondly, it directly affects your mortgage and the economy. And thirdly, the bond market has a great deal to do with rates of inflation. At the end of our last video, I promised that in today's video, we would look at the relationship between bond prices and interest rates in a bit more detail and explain why governments have far less power to set interest rates than you might think and why this is. As I say, it's really important to understand this stuff if you want to maximize the chance that you can become wealthy, and very, very few people do, including most of our politicians, as I said last time. So the first thing to do is to explain the relationship between bond prices and interest rates. And the important thing to understand is that these two things are what's called inversely related. That's to say that lower bond prices imply higher interest rates and vice versa. More accurately, lower bond prices are higher interest rates. So let's explain how this works. Imagine that the British or the US government is selling a one-year bond worth $100 and offering to pay you $5 of interest on that bond. This means that if you buy, that is to say invest in that bond, you're entitled to $100 of capital and $5 of interest back at the end of the one-year term. So if you pay $100 for this bond, your return on that investment will be 5%. You pay $100 and after a year you get $105 back. A simple percentage return calculation shows us that this is 5%. Crucially, however, there is a secondary market for bonds that we talked about in our last video, i.e. where bondholders can buy or sell their bond holdings on any given trading day. In that market, bond prices constantly move up and down depending on what investors all over the world feel about the country or company that's issued those bonds. In the secondary market, you can end up paying more or less than $100 for $100 worth of bonds based on the animal spirits of thousands of investors running trillions of dollars in the global bond market. So to go back to the example we used earlier, we've a one-year bond which is issued at what is called a face value of $100 and will pay you $5 of interest at the end of a year. When that bond was issued by whichever government, you would pay $100 and get back $105 in total over the one-year life of the bond, implying a 5% return as we saw. Now imagine, however, that a few days after this bond was issued, investors were willing to pay $101 for that same bond. If this were the case, the percentage return implied by the price they're paying there, mathematically, would be around 4%. This is because you're now losing 1% of your capital because you've paid $101 for the bond, but you only get $100 of capital back at the end of the year, and your percentage return on the $5 of interest you're owed is a tiny bit lower than before because it's $5 divided by 101 instead of by 100. And similarly, now imagine that investors were only willing to pay $99 for that same bond in the secondary market. At this price, their return would be more like 6%. And this time, this is because they're making a bit more than 1% on their capital. They've paid $99 but receive $100 back of capital at the end of the year. And the $5 of interest promised represents a slightly higher fraction of $99 than it does of $100. And that's why that bond would now yield around 6%. And this is why lower bond prices mean higher interest rates and vice versa. They're two sides of the same coin. This might sound all extremely boring and technical, but it is very important to understand. Governments that need to raise money to pay for all the things their tax revenue can't cover must sell bonds to investors at home and abroad to make up the difference. If those investors are less confident about the financial strength of that country, they will want to pay less for that country's bonds. And this will mean that the price of those bonds will fall, and lower bond prices mean higher interest rates, as we've just seen. This is a hard mathematical relationship, as just explained. And the general point here is that governments have rather less power to set interest rates than many people realise. This is because the massive global bond market, which is made up of thousands of huge investors from all over the world with trillions of dollars, pounds, euros, yen, and so on, is fundamentally more powerful in aggregate than pretty much every single country in the world when it comes to setting bond prices and interest rates by extension. Even the US government has far less power to set its own interest rates than you might think. This is where the phrase bond vigilantes comes from, which you may or may not have heard of. What it means is that the bond market is inherently more powerful than any government when it comes to setting bond prices and interest rates. If the global bond market doesn't want to buy a country's bonds, that country will have to cut the price of those bonds until someone will. And this drives interest rates up. The next important thing to understand is that if a country controls its own currency and central bank, as is the case in the UK and the US, for example, and if they'd rather not see interest rates go up, what they can do in this situation is to invent new money out of thin air to buy their own bonds, as crazy as this sounds. This is something called quantitative easing, or QE for short, which you may have heard of in recent years. And between 2009 and 2022, the UK has done £875 billion worth of QE. QE can keep bond prices artificially high and interest rates artificially low as a result. The problem is, however, that this tends to create inflation. When governments do this, they can keep interest rates low and raise money to spend on the things that they want to spend money on, but the value of that money will reduce because of inflation. And this is precisely what has been happening for the last several decades. There are a number of reasons why governments want to keep interest rates lower than what the natural bond market level might be. Falling bond prices, i.e. rising interest rates, are something of a vicious spiral for many reasons. First, as interest rates rise, the government needs to pay more to borrow money and has a much higher interest bill too. This makes investors even less willing to invest in that country's bonds as they worry about the financial strength of that government. And this is arguably what's happening in the UK right now. The UK government's interest bill alone at the moment is not far off £100 billion a year, which is more than we spend on each of education and defence. That's just on our interest bill. And only a couple of weeks ago, Ray Dalio, who's the founder of one of the biggest investment funds in the world, suggested the UK is currently at risk of entering a bond death spiral. Whether he's right or not, it's very bad news that someone like him would be saying such things. High interest rates also put a brake on the real economy for the following other reasons. First, people are less inclined to take out a mortgage or other loan or form of credit, and this depresses the housing market and the retail sector, more or less obviously. Secondly, those who have a variable rate mortgage will see their monthly payments go up and they will have less to spend as a result, which means the rest of the economy suffers. And if interest rates increase too much, people may even end up being forced to sell their home, something we may see a fair bit of in the near future, sadly. And thirdly, companies are less likely to hire people or invest in a new factory or a piece of equipment, because if borrowing money is more expensive, then they'll make fewer investments overall. Any government that's mismanaged its financial affairs will find itself having to drop the prices of its bonds in order to sell them and raise enough money. This results in the extremely unpopular and economically damaging reality of higher interest rates, as the alternative is not being able to raise money on the bond markets at all. Given that neither of these options is a vote winner, plenty of governments throughout history have decided on the other option, which is to invent money out of thin air to buy their own bonds. Governments in this situation, if you like, are stuck between the rock of higher interest rates and the hard place of higher inflation. It's very important to understand that inventing money out of thin air has been attempted dozens of times throughout history and been described in various different ways, such as debasing coins, printing money, QE, and so on. It's almost always resulted in economic disaster for the country or society involved, over the long run at least. Examples include in ancient Rome, in Weimar Germany in the late 20s, in Argentina and many other Latin American countries in the 1980s and 2000s, and more recently in Zimbabwe, home of the $100 trillion note, as recently as 2009. For most of history, places like the US and the UK didn't need to play this game. Their economies were strong enough that they could pay back their debts with real money and could keep bond market investors happy buying their bonds at relatively low interest rates. They didn't need to invent any money out of thin air. Sadly, this is no longer the case. For the last many years, both the USA and the UK have had to resort to inventing money to buy their own bonds in order to keep interest rates artificially low. This is a big part of why we've had a cost of living crisis. And this is also why John Maynard Keynes, arguably the greatest economist of the 20th century, said, by a continuing process of inflation, governments can confiscate secretly and unobserved an important part of the wealth of their citizens. This is exactly what is happening. The UK and US governments in particular have invented more and more money out of thin air. In 2000, something called the M2 money supply in the US was about $4.7 trillion, for example. By 2023, this number had reached nearly $21 trillion. And in the UK, the number was below £1 trillion in 2000, and it's now just over £3 trillion. That is to say that we've tripled or even quadrupled our money supplies in the last couple of decades. The authorities also do a great deal to manipulate the inflation numbers, as we saw in a video I did a few weeks ago, so that you don't realise just how high real inflation is as a result. Perhaps even more worrying than this endless money printing and misleading inflation numbers, however, is the fact that many of our politicians simply don't understand this stuff. This is abundantly clear to me. I wonder if even 5% of our MPs understand the subject matter in this video. And even more worrying still, there's been a certain kind of academic economist in recent years who have argued that QE doesn't create inflation, particularly those who follow something called modern monetary theory, or MMT. And I would argue, more or less passionately, that these are some of the most clueless and damaging and dangerous academics in our modern world. And it's an outrage that so many of them are teaching economics in our universities. Their theories ignore centuries of real-world evidence and the policies they advocate, and which financially illiterate politicians have been all too willing to implement, given how nice it has been for such folk to believe in magic money trees, have created economic misery for hundreds of millions of people in recent decades, and this is only likely to get worse, which is part of the reason I spend time making these videos. As I've said before on social media, I'll take economic history over economic theory every day of the week. So that's it for today. I hope you found this video useful, even if it's been a little bit depressing. In future videos, we'll continue to look at what you can do about all of this stuff to ensure that you suffer less than so many others, given what is going on. So as ever, if you want to ensure that you're one of the first to see our videos in future when they're published, please do click the subscribe and bell buttons. And please do share our videos if you think they're valuable. And please do also think about subscribing to our free email service from the Plain English Finance website. And if you'd like to hear from me more often than just these videos, please do connect with me on any or all of LinkedIn, Facebook, or Twitter or X. Until next time, I wish you the very best.